This is the IRS Problem Solver Podcast. I'm David J. Griggs, CPA. If you've got tax debt, payroll tax issues, or the IRS is coming after you, you're not alone. Each week, I share real strategies to stop collections, protect your business, and take control of your tax problems legally and effectively. Let's dive in. If you've ever wondered if filing bankruptcy could erase your IRS debt, you're not alone. A lot of people assume that a bankruptcy is the quick way out when tax debt piles up. But the truth, it's a little bit more complicated than that. Today, I'm going to walk you through exactly when bankruptcy can help with IRS problems, when it won't, and the other options you may want to consider. By the end of this episode, you'll know the real story behind bankruptcy and taxes, so you can make smarter choices. Now, before I start, I'm not an attorney. I know how bankruptcy interacts with tax law, but outside of that, I really don't have any idea. Always consult with an attorney on your specific situation before doing anything. Now then, let's break down what bankruptcy actually is in plain English. Bankruptcy is a legal process that helps people who are drowning in tax debt get a fresh start. The two main types that individuals can use are usually Chapter 7 and Chapter 13. Chapter 7 is a liquidation bankruptcy. It's the one that you hear about whenever the debts are wiped out and assets are sold off to pay off the creditors. Now, Chapter 13 is probably the one that you hadn't heard that much about, and that's more like a restructured payment plan over 3 to 5 years. Now, exactly how all those work, I do know how they work with tax debt. So now bankruptcy can deal with credit cards, medical bills, personal loans pretty effectively, but when it comes to the IRS debt, that's where things get a little tricky. There are very specific rules that decide if your tax debt qualifies to be erased in bankruptcy. And you can remember them by these three numbers: 3, 2, and 240. So let's simplify those. First off, the 3-year rule. The tax return must have been due at least 3 years before you file bankruptcy. So if you owed for 2019 taxes, which were due on April 15th of 2020, those wouldn't be old enough until at least April 15th of 2023. So 3 has to be due at least 3 years before you file. 2, the 2-year rule. You must have actually filed that tax return at least 2 years before the bankruptcy. If you filed late, the clock starts when you file. And this is the one that gets most people. Okay. I've seen a lot of people come in and they had done a bankruptcy for a period that would have qualified under the other rules. But because they hadn't filed the tax return, the debt was not dischargeable. In fact, I had a client several years ago who had come to me. We'll call him Rick because that's everybody's name whenever their identity is being concealed. He had filed bankruptcy for, I think back in 2020, 2019 or something like that. And he had unfiled tax returns from 15, 16, 17. And had those tax returns been filed, the debt probably would have been discharged. But because the tax return had not been filed, even though the 3 rule was met, it was due at least 3 years before you filed bankruptcy. It didn't meet the 2 rule. It hadn't been filed 2 years before he filed the bankruptcy. And a lot of bankruptcy attorneys don't, it's not that they don't know this, it's that if you have unfiled returns, their hands are really tied. Okay. They're not trying to get in there and have you on as a client for multiple years while they wait on that 2-year rule. So it's always good that if you are considering bankruptcy and you know that you could potentially have tax debt from prior years that you may or may not have filed yet, to consult with a tax professional that understands these rules and how they work with bankruptcy. I know at least in my firm and my practice, we have no issues working with bankruptcy attorneys and collaborating on our clients to make sure that we get the best result possible for them. Okay. So always check on that. The 2-year rule gets a lot of people. 240. This is the 240-day rule. The IRS must have assessed the tax at least 240 days before your bankruptcy. Now, what is the difference between the 2 and 240 rule? You have to file 2 years before, but they have to assess the tax 240 days before. Here's where it gets most people. We can have tax returns that have been filed 2 years ago, but the IRS has come recently within the audit statute of limitations because they have 3 years to come and assess new taxes if you left something off, which I see a lot. And if you leave something off, that is when the 240-day rule applies. So it might meet the 3, it might meet the 2, but if the IRS just assessed it, you have to wait another 240 days before that's dischargeable in bankruptcy. Once you start and file that bankruptcy, that's when it counts. And 240 days is 8 months. And here's a really big point, okay? We're talking about income taxes only. Individual income taxes, businesses, payroll taxes, all that stuff, they have completely different rules. And taxes related to fraud are never dischargeable, and we'll talk about that in a minute. Bankruptcy does not magically erase all tax debt. It's not going to help if you never filed the return because it does not meet the 2 from the 32240 rule. It's not going to magically erase a fraudulent return. Pretty much anytime there's fraud involved, like a substantial understatement of income or substantially overstated expenses that results in a liability that's way less than what it should have been, typically 25%, but there are other rules that go into that, as considered fraud. It also opens people up to criminal investigations. That's where you see the people like Wesley Snipes and Martha Stewart. They substantially understated their tax liability, got opened up for fraud. Those debts are not going to be dischargeable in bankruptcy, regardless of how long ago they were. If you meet the 32240 rule, doesn't matter. The next time that it's not a magic bullet, is if the debt is payroll taxes that you withheld from one of your employees. For those of you that are on W-2, I'm sure everybody has gotten a W-2 at some point. Whenever you get the W-2 and you have Social Security and Medicare withheld out of your check, that's the employer withholding taxes that you owe the government on your behalf. They hold it in a fiduciary capacity. So what that means for the employer is it's never their money. So whenever you withhold taxes from the employee and you don't remit them, you end up with what's called a trust fund recovery penalty. And those are the worst penalties to get. They're not dischargeable. A lot of the different programs don't count. They're very difficult to get rid of. That's a big thing. So if you have a trust fund recovery penalty, you are not going to be able to discharge that in bankruptcy. And again, if you don't meet the 32240 rule, it's not going to get discharged. So this is where a lot of people get surprised. They assume everything goes away whenever they file bankruptcy, only to find out that the bankruptcy didn't deal with most of the IRS balance. Almost everybody that I've picked up in my firm that has filed bankruptcy prior to getting with me has missed something on their tax debt because they didn't file the returns, is usually why that happens. But here's the thing. Sometimes you can't wait. You got to file the bankruptcy. But if your tax debt doesn't qualify, don't panic. There are definitely alternatives. One, you've got the offer and compromise program. This is the one where it's settled for pennies on the dollar that you see all the ads for. It settles with the IRS for less than what you owe if you qualify. And that's the caveat here. You have to be able to qualify for this. They're going to look at your income, your expenses, your assets, and they're going to make a determination based on the reasonable collection potential of your debt. So if you owe $100,000 and they think that they can collect $100,000, they're not going to settle with you. If you owe $100,000 and they think the most that they could possibly collect from you is $15,000, they might settle with you for $15,000. It's a long process. It's difficult to get into, but it has a really big payoff if you don't qualify for bankruptcy and you're just looking to settle IRS debt. Sometimes that can be a really good strategy. Installment agreement. This is what most people are going to qualify for. So if you can't qualify for bankruptcy or you can't discharge your tax debt in bankruptcy, you could probably qualify for an installment agreement. And it's essentially just a payment plan. One, you can full pay. Let's say Rick owes $100,000. You're going to pay out $100,000 over the life of the statute or 72 months, depending on which one you do. But the longest that you can go is the statute of limitations, which is 10 years from when you filed the return or when the balance was assessed. Interest and penalties continue to accrue. Now, that's a full pay. Partial pay is essentially do a lot of the similar things to an offer of compromise, especially with the income and expenses, and you get a discretionary amount left over based off of your income and allowable expenses. It's not all expenses. It's only what the IRS is going to allow, and they're pretty strict on that. Okay. And then based on that, if the amount that you can pay is considerably less than what a full pay, that's going to be called a partial pay installment agreement. And you essentially will make that payment over the life of the statute. And then whenever you get to the end of the statute, obviously you haven't paid the full thing off, but it gets written off on the government side. So it goes away. And the last one is currently non-collectible. Okay. And this is essentially where you do all the same things as you would have done in the partial pay installment agreement, but you get down to the bottom and your discretionary income is zero. You have no more money left over to pay the government right now. They'll put a flag on your account that says currently not collectible due to hardship. And this status usually lasts 2 to 3 years, and that's what's in their internal revenue manual to be looking at. They can come back every 2 years and reevaluate your need to be in that program. If your income goes up, you have discretionary income. After they reevaluate you in 2 years, you'll have to go after something else, probably an installment agreement or a partial pay installment agreement. But it essentially, it stops all the collections. You still owe the balance, and you will continue to owe the balance until the statute of limitations runs out. Sometimes these solutions that I just outlined are more effective and less damaging to your financial life than bankruptcy, because bankruptcy is pretty invasive at the end of the day. It stays on your credit for 7 years. I only deal with the tax side, but you have a lot of options outside of bankruptcy for getting rid of tax debt. So let me give you a quick story. I had a client who owed taxes for several years, 2016 through 2022. The older years, 16 and 17, they met the 32240 rule, so they could be discharged in bankruptcy. But the newer years, like 2020 through 2022, those were too recent. Bankruptcy only wiped out part of the debt. And by combining these tools, both bankruptcy and an installment agreement, the client was able to move forward without being crushed by the debt. And this shows why you need a strategy, not just a quick fix. And sometimes it pays to consult more than one person. You know, you can consult us on the taxes, and we might refer you over to a bankruptcy attorney. It's important that professionals work together. So don't be scared to consult somebody else just because one. Can bankruptcy erase IRS tax debt? The answer is sometimes yes, sometimes no. It depends on your situation and the age of your tax debt. What's important is that you don't make this decision blindly. Okay? Bankruptcy is a huge step, and you want to be sure that it's the correct move. So if you're struggling with IRS debt and wondering about bankruptcy, don't go it alone. Reach out to us for a free consultation. We'll review your situation, explain your options, and help you choose the right path. Bankruptcy might be one solution, but it's definitely not the only one. Thanks for tuning in today. If you found this helpful, be sure to subscribe to the podcast and share it with somebody who might need the information. Until next time, take care and remember, you don't have to face the IRS alone.